Well, this is a lot of fun. It's a very interesting crowd, very smart. I've done a lot of these conferences in the last year or so, and intellectually, this is probably a pinnacle. There's an awful lot of very bright people here. The thing that we've experienced at Allegiancy, I'm the Chief Executive Officer of Allegiancy. We are a real estate asset manager in much the same way as a financial asset manager guides investments on your behalf. We guide commercial real estate investments on behalf of those owners, and we do lots of real work in that. And we've been in this business for 10 years or so. And then last year we went out and sort of looked at our business model and decided that acquisitions was an important opportunity for us. At which point we looked at how can we raise this capital efficiently and effectively. We were anticipating, being foolishly optimistic as most entrepreneurs are, that Regulation A rules would be promulgated promptly, and so as time ground down, we opted to go out for a $5 million raise under the old Reg A in anticipation that sooner or later these guys would get around to writing the rules and A+ with a $50 million limit would be available to us. And so that's what we did. We found a broker-dealer, Maloney Securities, that was excited about the space, was building a secondary market trading platform, and was willing to commit some resources and some time to build that investment banking infrastructure around Regulation A+ securities offerings. And we went out and did the traditional roadshow and raised $5 million. And it was a lot of work. It was a lot of, there was a lot of pain, but I would tell you from our perspective, that pain was worth it, that there's an awful lot to commend a public platform securities offering over a private placement securities offering. And in an affiliated company, we've raised probably $300 million of Regulation D money for direct real estate acquisition. So we've lived in the Reg D world for a long time, know a lot of the guys that are in the Reg D world. But if you were to look at the demographic of independent broker-dealers, what you're seeing is old people. They are all 50 plus, the guys that are really doing most of this fundraising in the Regulation D world. And most of those guys are moving out of the business. And we think that the Reg A Plus is going to do an awful lot to replace Regulation D. And there's some good reasons that that would take place. Why do we think Regulation A matters? Well, I think there's an interesting dynamic. There's a fundamental tension between sort of the old guard and the regulatory infrastructure that's always seeking to tighten things down so it's easier to regulate, that's seeking to narrow the focus, shrink the pool so they can control what's going on. And you see it with FINRA. FINRA has been actively squeezing smaller broker-dealers out of the market because they are, by and large, they're the entrepreneurial guys, they're the cowboys, and their regulatory compliance infrastructure is generally light. And so they end up causing trouble for the regulators. And so they're working diligently to shrink that pool and run those guys out of business. Banking, same thing has been happening. A lot of the community banks are under enormous pressure from the regulators. And so you've got this tension going on. And at the same time, the Jobs Act has opened up a whole new avenue for the entrepreneurial innovators to go out and raise capital and make interesting things happen that probably will ultimately define the future for this country and for technology in this country. So we think it matters a great deal that Reg A Plus and its current iterations, Title 2, 3, and 4, are going to make a big difference. And there are a couple of things that you probably all heard bandied about in the news that have been going on in the country for a long time. Gallup did a poll recently talking about the entrepreneurial decline in America and how there are more business deaths each year than there are births. And so you have a shrinking population, what I call the Japanization of the entrepreneur. You got more people dying than you have being born, and the math looks bad. You are also simultaneously, and I guess not really a big surprise, but you're at a point in the United States where we have the lowest level of self-employment in the history of the country. And so you have, I think, a sort of a pressure cooker that's working against entrepreneurs, and part of that is capital fundraising. I mean, part of that mix is the capital pie. But most of you probably also know that millennials, who obviously are the biggest generation since the baby boom, 40% of millennials have indicated an unwillingness to start a business or work for a startup. Think about that, not just start a business, but work for a startup. 40% have indicated they're unwilling to do that because they think funding and capital availability is going to be a problem. They can't get a loan, they can't raise the equity. If you've got the biggest generation in the history of the country coming along, and 40% of them don't want to be a startup and don't want to work for a startup, that's a big deal. That's a big problem. And so I think the Jobs Act and all the hard work that's being done by people in this room and people up on the Hill to try to make those changes, I think that is a very big deal, and we should all get behind it and do what we can to help promote it. Because small and medium-sized enterprises are 100% of the net new employment in this country. And so you look at the quote-unquote recovery we're in right now, it's a jobless recovery. I mean, the employment statistics are horrible, particularly if you measure them the way we used to measure unemployment back in the 80s. The employment is terrible. And part of the reason it's terrible is because the new job engine, small to medium-sized enterprises, are under so much pressure. They're undercapitalized, they're overregulated, and Jobs Act and Reg A, I think, is driving the change there. And this is exciting stuff. And so when we decided to go down the Reg A path instead of Reg D, we were looking at the opportunity to raise capital from a broader selection of investors, to move out away from just accredited investors and be able to talk to and have conversations with non-accredited investors. If you think about the investor pool as a pyramid, the accredited guys are at the top, and there are not that many of them. And then below that is an enormous group of people that we had heretofore had to turn away and say, I'm sorry, you don't meet the standard. We can't, even though it might be perfect, we can't allow you to be a participant. And so Regulation A+ has reduced a lot of that regulatory barrier, and it's also, in our view, it's reducing a lot of risk. Because it's a public security, because it's gone through SEC scrutiny, regardless of whether you think that is scrutiny enough, but it's gone through that process, and we can now market that security broadly, and we don't have the accredited standards and the validation of all of that as an issuer. We don't have to worry about those things in the way we used to with Regulation D. And so part of what we looked at was a wider audience of investors that's available to us now, and a reduction of ongoing risk as the issuer, because our securities are, we have transparency in terms of financials, we have audits, we have that lower, if you will, risk for us to get sued or have a securities issue because of the standards. So those are all the things that we were thinking about. As we set out now, we expect to file somewhere between a $30 and $50 million offering, depending upon the structure of the security. We'll file that with our friends at the SEC on June 19th. We figure it'll take them 90 to 120 days to get through the process, and then we'll be live in the market, hopefully in the fall after everybody's back from summer break and we're all focused on business again. We'll get that thing done. Our Reg A offering was fully subscribed in 30 days, so we're very excited. I think there's a lot of demand in the marketplace for new opportunities. And so not only is this important for companies who can then invest and grow. I mean, our company has doubled in size in the last year. We've added 10 employees. We will be doubling again, at least doubling again this year, even before we do the next offering. That kind of growth, it matters, and it employs people. But it's also important for the investors, because today investors have been under financial repression, as in artificially low interest rates, artificially low returns on fixed income securities. For what? How long have we been doing this? 5 years? It's longer than that, isn't it? 7 years that they've been under that financial repression. And new securities in the Reg A+ world will, I think, afford investors opportunities that heretofore have been limited to the accrediteds, the private equity funds, the venture capital guys, and the rich guys. And so I think that democratization really goes both ways. It's both for issuers and for investors. So thank you very much. Our minimum was $50,000, and of course, as always, we reserve the right to waive that if we love the person. So.
One more? Okay. So this isn't a question, this is a comment, Steve. A lot of us have been at the same time.
Yes, I dressed myself.
And one of exciting things, I think, over the next year is the emergence of voices like yours of companies who have used the tools and have raised money. And we'll start getting the voices of investors who have contributed and gotten returns. So I want to say, I know it'd be very, probably easier for you and for your investors to stay focused on running your business. So thank you for taking the time to come and participate and help lead this conversation.
No, thank you. My pleasure.
Thank you, sir.
Thanks very much.